Welcome to the final video of the Share Navigator's Options 101. In our previous videos, we introduced you to options and saw how they work in everyday situations, how they get to trade on an exchange, and some real-life examples of a call and put option with Apple. Today we're tackling one of the most crucial topics, option pricing, also known as the option premium. This is the cost you pay to buy an option, and it's made up of two main components, intrinsic value and extrinsic value. Think of the option premium as the total price tag of your option. When you see an option quoted at, say, $2.50, that $2.50 is its premium. This premium isn't just one number plucked out of thin air. It's a combination of its inherent worth and its potential worth. Let's start with intrinsic value. This is the real value an option has if you were to exercise it right now. It's the immediate profit you'd make. For a call option, intrinsic value exists when the stock price is above the strike price. Imagine a call option with a strike price of $100. If the stock is trading at $110, you have the right to buy it for $100, which you could immediately sell for $110, making a $10 profit. That $10 is its intrinsic value. For a put option, intrinsic value exists when the stock price is below the strike price. If you have a put option with a strike price of $100 and the stock is trading at $90, you have the right to sell it for $100, even though it's only worth $90 on the market. That $10 difference is its intrinsic value. These concepts lead us to three important terms. In the money, ITM. An option is ITM if it has intrinsic value. For a call, the stock price is above the strike price. For a put, the stock price is below the strike price. At the money, ATM. An option is ATM when the stock price is equal to the strike price. It has no intrinsic value. Out of the money, OTM. An option is OTM when it has no intrinsic value. For a call, the stock price is below the strike price. For a put, the stock price is above the strike price. Remember, OTM options are cheaper because they don't have that immediate real value. Now for the other part of the premium, extrinsic value. This is often called time value or speculative value, because it represents the potential for the option to gain intrinsic value before it expires. Even OTM options, which have no intrinsic value, will always have some extrinsic value, unless they're expiring right now. Extrinsic value is influenced by two main factors, time until expiration and volatility. First, time value. The longer an option has until expiration, the more time there is for the underlying stock to move in your favor and for the option to become profitable. Because of this potential, options with more time until expiration are generally more expensive. However, time value isn't your friend if you're holding an option. This value decays over time, a phenomenon known as theta decay. As an option gets closer to its expiration date, its extrinsic value diminishes, and it does so at an accelerating rate, especially in the last 30 to 45 days. By expiration, all extrinsic value will be gone. Next, volatility. This is a measure of how much the stock price is expected to fluctuate. High volatility means bigger price swings are anticipated, which increases the chance that an out-of-the-money option could move in the money, or that an in-the-money option could become even more profitable. Because of this greater potential, options on highly volatile stocks tend to have higher extrinsic values. We talk about two types of volatility, implied volatility, IV. This is the market's expectation of future volatility. High IV means the market expects larger price swings, leading to higher option premiums. Upcoming earnings announcements will usually increase implied volatility. Historical volatility, HV. This measures how much the stock's price has fluctuated in the past. Traders often compare IV to HV to gauge if options are relatively cheap or expensive. Generally, higher volatility, whether implied or historical, will lead to higher option prices, as there's more potential for significant price movements. So to recap, the option premium, or price, is the sum of its intrinsic and extrinsic value. Intrinsic value is the real value an option has right now if it's in the money. Extrinsic value is the potential value, driven by time until expiration, which decays, and volatility, which can make options more expensive. Understanding these components is crucial for making informed decisions when trading options. In our next video, we'll dive into how options are actually traded on an exchange and look at some real-life examples. Don't miss it. Congratulations! You have completed the Share Navigator Options 101 course. This 101 course has covered the fundamentals. To continue your education, we offer full, comprehensive courses dedicated entirely to various option strategies so you can profit from rising, falling, and sideways trending stocks. We wish you the best in your continued trading education. If you would like to fast-track your learning, consider taking a trial of our one-to-one mentoring service. Get direct, personalized guidance from a trading expert to master these strategies faster than ever. And also learn from our real-life option and futures trades. Contact us and request a free trial of our mentoring service. Visit sharenavigator.ie.